Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to another edition of the Grain Feed, brought to you by EverAg. This is your weekly news feed for all things grain and all things feed. Each week we bring you updates on the markets with unique perspectives from an amazing team of analysts with the intention of helping dairy and livestock producers manage their risk. I'm your host, Jim Matthews, reporting from Chicago, and it is a wild little weather day here. These skies outside overlooking the Board of Trade and to the south are like orange, and there's weird stuff happening out there. I don't know what it is, but there's going to be rain later and then snow. Someone said a snow tornado and then maybe snow thunderstorm, and there's just a lot happening in Chicago. So, you know, if this is the last grain feed you see, you'll know why, but we're going to try and stay safe out there. Joining me from another potentially wild corner of the world in terms of winter weather at any given time in Western/upstate New York, we have the Market Intelligence Director at EverAg, Miss Kathleen Wolfley. Kathleen, how are we today?
I'm great. I will note that I find it a little funny that you're reporting on the weather from a windowless room.
Yes, I am. I swear I do have a desk where I actually work, in case people were curious. I try to work here and there, and the window faces the Board of Trade in Chicago, and we get this full skyline to the south of what's coming up the prairies, if you will, in this flat state of Illinois. But otherwise, when I come in here to do the show, I have no idea what's going on.
It's a beautiful day here in Western New York.
It's great.
Sunny, 70-ish degrees.
Oh, come on.
Yeah, I went out this morning and it was really lovely.
Well,
But I know that the tide is turning. Soon it's going to be 40 and rainy once again.
yes.
But I can't remember if I talked about this on this podcast or not in the past, but there was a Little Tikes plastic slide that had blown away in the wind,
Oh,
and it was in the ditch covered in ice. And
oh my.
I'm happy to report that the Little Tikes slide has since been rescued.
Okay.
It's a little worse for wear, but
You're trying to tell the viewers and listeners you got your slide back.
we got my slide back.
Okay, gotcha.
Yeah.
Your slide blew away.
Don't worry, everybody.
You got it
The
back.
glaciers have melted in
Yeah.
Western New York.
And then do your kids also have a slide?
Yes, they do.
Okay,
do.
good.
A variety of slides at the Wolfley household.
It's not okay, good. Good deal. Well, it's still spring in the north, if you will. So we all take our turn of this tease of warm weather versus not that cool versus way too cool, if you will. So it's just a matter of time. Speaking of time, Paige, if you would kindly timestamp the broadcast. It is Wednesday afternoon. It's about 3:15 Chicago time. Kind of an interesting week here as the grain and feed markets are at this stage really just waiting for the March planning intentions report on the 31st. So a little bit of a consolidation mode until then at the moment. So to review, we have settlements as we record in the afternoon. We have May corn up 3.25 cents at 4.62, whereas December Christmas corn was down 2.75 at 4.51.5. So Dece corn still hovering near that 4.50 level and finding some support there and managed to close above that level today. We have May beans down 4.5 at 10.08 with Novi beans down 5.5 at 10.10. And then we have May meal, that slightly less stubborn little byproduct, was down 2.20 per ton today at 297.70 per ton. So we do have nearby meal closing below $300 a ton again today. So we closed it below by, I think, a tick yesterday. So we're maintaining some of that pressure on the soybean meal market. And December meal was down 280 at 313.60. So we have some opportunities there in the protein markets as we move into this end of March. And I keep referencing a lot of folks that we talked to about that end of March planning intentions report. Really a very pivotal report when it comes to the grain and feed markets. It's the USDA's initial projection based on actual survey data of what our U.S. farmers intend to plant this spring for the next crop year. A lot of the market round number is 94 million acres of corn for those folks out there. I think the bean corn ratio is something that we've referenced with Jay Kingsley on, has provided some really interesting dialogue over the last several weeks over where the row crop farmer's been able to capture some potential pricing and sales for that corn he may or may not intend to plant. We'll see with that report. But overall, feed has largely been under pressure, relatively speaking, to the month of January and February. As we turn to the dairy side of things, one would hope that maybe margin would have looked a little bit better with feed coming under pressure. But Kathleen, things have not been outright bullish lately in the milk markets, have they? What's happening in the dairy markets as of late?
Certainly not. I mean, it's been a wild ride in the last 2 weeks, I'd say. Basically, the end of February saw cheese prices really take a dive into the low 160s, got a little bit bounce back up. And then early this week, things got crushed once again. Cheese prices down into the mid 150s, got a little bit of bounce back on block cheddar today, but still, we remain fundamentally quite weak in the cheese market. But surrounding that is just a ton of noise. And on the class 3 future side of things, it's been equally noisy with markets really all across the board. Right now, for most of the, let's say, second quarter, we're in the mid $17 range, low $18 range as we get into the fourth quarter. So certainly a big shift from where we were trading to start the year. And I'd say it's a similar story in the class 4 space. We were looking at how does the implied class 4 price, so that's using butter, non-fat dry milk spot prices day in and day out. So at the beginning of January, we were in I think it was $20.40 on the implied class 4 price. Today, that's sitting at $17.49. So we've nearly wiped out $3 per hundredweight in the implied class 4 space since the beginning of the year. And a lot of that's coming off the downside pressure that we've seen in a butter market, down almost 25 cents over that same period. The non-fat price at the same time down a little bit more than 20 cents. So a lot of pressure in the dairy space, whether you're looking at cheese, butter, non-fat dry milk, and even the whey markets.
I think some of the dialogue of that mid to late February was not just the milk market starting to break down, or the dairy markets, if you will, but also grain and feed markets. And I think something we've explored with some of our colleagues here at Everag as well is it was not just commodities either. I mean, it was the equities markets took a major plunge really around the same time. I mean, I'm not sure if it's the day, but you can nearly pinpoint where these stock markets ultimately peaked and then plunged lower, perhaps the same day as the corn market. They came very close to having that same trigger. I think a few things happened, and we talked about this earlier this week, Kathleen, about the consumer sentiment surveys have really started to plunge. We've had some of obviously the volatility of the trade issues, and are we doing a trade war versus not a trade war? Is it with Mexico and Canada? Is it not? We've seen some changeover with Canadian leadership lately. How does that impact things? But for whatever reason, the consumer sentiment has decided it is not feeling good about the U.S. economy, or as good. And we saw a lot of things start to implode. I think one could argue for at least equities and focusing on that corn market, perhaps some de-risking from managed money, who had a significantly large net long position in corn. Obviously, a very long position in equities at record highs earlier this year. So something helped at least trigger these folks to say, let's take some money off the table and see how this thing does. Is that having an impact directly on the dairy market in terms of a concern over the U.S. economy and concerns over the consumer demand for dairy?
I don't know as though we can make a direct correlation between, or causation between, drops in consumer sentiment or drops in the S&P 500 and how that relates to the dairy industry. But what I can say is that from a consumer demands perspective here in the domestic market, weakness continues to be a key talking point. As we look at food service demand, traffic is down. Retail sales and retail traffic has been increasing because at the same time, we still need to eat. But I think folks are looking at persistent menu inflation as a sticker shock around going out to dinner. Prices are up almost 30% over a 5-year period to go out to eat. And there was a Wells Fargo study that I looked at last week that said, I think it was 75% of consumers have had sticker shock when eating it at a restaurant or seeing that bill at the end of your meal and thinking, that was way more than I expected it to be.
Yeah.
I think that folks are seeing that those increased costs at a restaurant and saying, you know what, I could probably make a pretty dang good meal at home if I put my mind to it, buying more product at retail. The key question is, how much did that really impact the dairy industry? Because again, we still have to eat, but are you seeing less waste because you're eating at home versus in a restaurant and you're leaving the leftovers there? Are the portion sizes bigger in a restaurant versus at home? So I think there are some trade-offs, but there's definitely questions around overall consumer demand. I think we see it in the class 2 space as well. People are maybe just not spending a lot of extra on ice cream in a restaurant or desserts in a restaurant or appetizers. I suspect, I haven't seen any data that supports this, but I suspect that check size is probably starting to come down a little bit, just as folks are looking at the budget and saying, hey, I've got enough money to spend on this, but I can't add a bunch of extra. So to your point, that was kind of a wandering answer, Jim, to say, I don't know as though there's a direct, like, if this, then that, when it comes to a weaker or potentially weaker economy or weaker sentiment readings and dairy demand. But just from what we've been picking up from folks along the supply chain, they suggest that, yeah, that restaurant traffic is really starting to take a hit.
Yeah. And you mentioned the 75% of the nation who has experienced sticker shock at a restaurant. Obviously, we wish the other 25% well on their yachts in Barbados and the rest of the floating around the ocean. Because I don't know how you go to a restaurant with 2 kids at home and bring them to the restaurant and say, yowzers, what on earth just happened here? So again, the other 25% hope you're well. But it's been a tough run, I think, for a few years now. And I think we've seen
Just
the
a quick
pivot.
call out. Jim said that he takes his 2 kids out to restaurants, which that does not happen at my house. You get takeout and takeout only.
There you go. Well, hey, the takeout check also has some sneaky inflation in there too. There's an element here of, I think, when we came out of COVID, if you will, and you saw that rush to dining out again, you saw the different types of inflation, if you will, of the costs at grocery stores being different than costs at restaurants. And you see the consumer usually manages to find a way of saying, if I'm getting squeezed over here, then it's easier to go here, vice versa. We'd also like to think that the US consumer just doesn't stop consuming dairy. They just find it in different places, if you will. And so you mentioned if you go out to a restaurant, you have a different way of consuming the nation's cheese, butter, and dairy supply. Whereas if you're at home grocery shopping, probably still consuming. I know we do at home, but it's in a different way than if you were out. And I think the interesting element of the concern over the economy and me trying to find a correlation or causation between like the corn market and the stock market, potentially finding this wave of liquidation at the same time. Demand for corn is actually really strong. I can't get into the logistics and statistics over at the grocery store, but in terms of the U.S. export demand for corn remains very healthy. The ethanol numbers that we saw this week, we are still grinding corn for ethanol despite fairly weak margins for the ethanol producers. So demand in that big global picture of the country's balance sheet for some of our commodity markets remain very robust. And yet we did see that big liquidation and some of that de-risking for managed money. So there's some way to tie that in there somewhere. But I know on our side, we're waiting for that very big report on Monday, the 31st. And then also April 2nd is supposedly a day where the president is going to announce, or I should say, put in place some of these reciprocal tariffs on our trade partners. What that looks like, we don't quite know yet. Does he include or exclude some of our immediate partners in terms geographically speaking? We don't know.
Uncertainty is rarely bullish. And I think that's kind of goes back to the whole discussion around we just don't know. And based on some commentary that I've read, I don't know as though the administration has a full grasp on how they're going to put those tariffs into place either. So there's still a lot of unknowns out there.
A lot of unknowns. And Kathleen, that is the line, right, of the day and past couple months is uncertainty. It's not necessarily bearish, but it's rarely bullish. And especially if you look at managed money where people have their portfolios allocated, if they're lacking that confidence of taking one particular direction in a market, We're going to see a lot of consolidation. We're going to see some weakness. I think that's what we're seeing so far as we head into the end of March.
Well, Jim, I do want to note quickly on the international front that as U.S. prices, particularly on the cheese side, have come down so aggressively in the last couple of weeks, it has put us in a more competitive position from an export perspective. So European mozzarella, EEX mozzarella prices this week at a 214, which I will note that the weaker U.S. dollar certainly puts us in a little bit better position there, versus barrels mid 150s. I suspect that phones are starting to get a little bit busier for exporters that are looking to move product into the international market. Certainly, as we've talked about, there's concern, uncertainty as it relates to tariffs, but there's 55% gap between the US and the European mozzarella price and US barrels. There are better opportunities on the table for US cheese exports than we've seen in quite some time.
Yeah, I think that's a really great point, Kathleen. And you brought up, the weakness of the US dollar. That is not to be overlooked, right? We saw the US dollar surging towards the end of the year and beginning of this year and remaining strong. And then really over the last, let's say 3 or 4 weeks, especially a couple weeks ago, is when it really started to plunge as well. So perhaps, again, with a slightly weaker US dollar, it does make it somewhat easier for someone with a foreign currency to then be able to buy a US dollar denominated product. And if that happens to be our cheese and our corn, and it makes it easier for them to do so, it does maybe provide an element of support that we otherwise would not have had with that incredibly strong US dollar. So that being said, Kathleen, speaking of the US dollar and taking your family out, any plans for spring break?
No, how about you?
I'm the other 25%. I've got that big yacht to
Oh,
hang
yeah,
out with.
I forgot.
Yeah, we're going to go make sure that Walt Disney's heirs are still doing well. This is the first official Matthews trip to Disney World is approaching here in a couple weeks. So I was worried that maybe they weren't doing as well. So I want to make sure that they're doing okay. And
Yeah, you got to worry about Walt Disney.
I'm a concerned citizen. What can I say? Speaking of sticker shock, that's been a fun one to map out. That's been a good one. But Kathleen, that being said, it is always a pleasure to have you on the show and to converse with you. There's a world out there, the Jim Kathleen podcast. It's there somewhere. We just need people to call in and ask for it, but it's there.
Yeah.
Like or comment below if you want a Jim and Kathleen podcast.
I will do that exactly. In the meantime, thank you very much. I was also called out last week for never thanking Jake Kingsley. So I know he's on the road visiting dairies and feed yards, but Jake, thank you for all that you do. He probably won't even listen to this, so it doesn't matter anyway. But we definitely like to thank the Everag Insights crew for their support. Thank you, Paige, for production magic. And thank you to the viewers for watching. The Grain Feed contact information is on the screen. We greatly appreciate your feedback. That's all for today. We'll see you next time on the Grain Feed.